If you want your paycheck to stop being the thing that controls your life, you have to understand one basic principle: income from labor and income from assets are not the same machine. When you earn a salary, you are paid because you keep showing up. Your time is the input, your effort is the input, your energy is the input. If you stop going to work, the machine usually stops paying you. When you own the right assets, the machine changes. Capital becomes the input, a system becomes the input, risk management becomes the input. And if the system is built carefully, money can keep coming in even when you are not trading another hour of your life for another dollar. That is the difference most people feel but never clearly define. They say they want freedom, they say they want to retire, they say they want passive income. But what they really need is very simple. If your job pays you $80,000 a year and you want to leave that job without lowering your standard of living, then your assets need to produce roughly $80,000 a year for you. Not someday on paper, not in a fantasy spreadsheet, not in some story where everything compounds forever and nothing ever goes wrong. Real income, cash flow, money that can pay bills. That is the bridge between working because you must and working because you choose to. But I want to be very clear about something before we go further. This is not easy. It is not instant. It does not happen because you watched one video, bought one ticker, or followed one person on the internet. It takes capital, it takes patience, it takes sacrifice. And most of all, it takes a clear system. Most financial advisors tell people to put money into the S&P 500 and let time do the work. That is not a bad idea. I believe broad ownership of productive businesses has been one of the greatest wealth-building tools in modern history. But there is a difference between building wealth and producing income. The S&P 500 may help you grow your net worth over time. But if your immediate goal is to replace a paycheck, you need to think differently. You need to ask a more practical question: where can capital be placed so that it pays me repeatedly, predictably, and with a level of risk I can actually live with? That question leads to 5 major asset categories. Some are simple, some are more advanced. Some require very little work after the purchase. Others require skill, judgment, management, and emotional control. The mistake is thinking all income is equal. It is not. Some income is stable but low. Some income is high but fragile. Some income looks passive until something breaks. A tenant leaves, a business slows, a borrower defaults, or interest rates change. That is why you must look at every asset through the same lens. What is the source of the cash flow? What can interrupt it? What happens in a recession? What happens if inflation rises? What happens if interest rates fall? What work is required from me? And what risk am I actually taking, even if the asset looks safe on the surface? That is how you start thinking like an investor instead of someone chasing yield. The simplest place to begin is lending money to the United States government. When you buy Treasury securities, you are effectively saying, I will lend money to the government, and in exchange, the government will pay me interest for using that money. That is the basic mechanism. There is a reason many people begin here. Treasury securities are generally considered among the safest dollar-denominated assets in the world. They are backed by the taxing power of the United States and by the Federal Reserve System behind the government's ability to fund itself. If the United States government could not meet its obligations, the consequences would be much larger than a bad investment decision. It would mean a global financial crisis. So, relative to most other investments, Treasury securities sit very close to the stable end of the risk spectrum. They also have a tax feature that matters. The interest from many Treasury securities is generally exempt from state and local income taxes. That does not mean it is tax. You still need to understand federal taxes, but compared with interest from a normal bank savings account, that state tax treatment can make a meaningful difference, especially for people who live in high-tax states. And Treasury income can be structured to come in regularly, depending on what you own and how you own it. You can build a stream of interest payments that feels more like income than speculation. That is the attractive side. But every asset has a trade-off. If you lend $100 to the government, your $100 does not become $200 because the government is growing a business for you. Your principal is not the growth engine. The interest is the income engine. That means Treasury securities are useful for stability and income, but they are not usually the place where your capital grows dramatically. There's also the issue of returns. Because the risk is relatively low, the return is normally lower than what you might expect from owning businesses, real estate, or private credit. That is how markets work most of the time. Lower risk tends to come with lower expected return. Higher return usually means some form of hidden risk is present, whether you can see it or not. And you should understand that Treasury securities are not the same as FDIC insured bank deposits. A bank account insured by the FDIC has one kind of protection. A Treasury bond has another kind of promise. They are both tied to the government in different ways. but they are not identical instruments for many investors. The simplest way to access short-term treasuries is not by building a ladder directly, but by using a treasury bond. ETF. One common example is a short-term treasury ETF that holds government bills maturing in 3 months or less. The purpose of that kind of fund is not to make the share price go up dramatically. The purpose is to collect interest from short-term government debt and pass that income through to the investor. At certain points in the interest rate cycle, these short-term treasury funds can pay attractive yields. When rates are higher, the income is higher. When the Federal Reserve cuts rates, the income usually falls. That is important. A lot of people look at a yield today and assume it will be there forever. That is one of the common mistakes. Interest rates are not permanent. They move with policy, inflation, growth, and credit conditions. If you build your lifestyle around a yield that can change quickly, you are taking a risk even in something that looks conservative. So the principle is this. Treasury securities can be a clean way to create income, especially for the defensive part of a portfolio. They can help you keep capital relatively stable. They can help you earn income without taking business-specific risk. But they are not a magic wealth machine. They are a tool. And the right question is never, is this good or bad? The right question is, what job does this asset do inside my whole system? After you understand the stable end of the income spectrum, the next step is to understand income from companies. This is where dividend-paying ETFs come in, a company that earns more cash than it needs for operations, reinvestment, debt payments, and growth may return part of that cash to shareholders. That payment is called a dividend. The idea is simple. If you own part of a business and that business earns profits, some of those profits can be distributed to you. But owning one dividend stock is different from owning a diversified collection of dividend stocks. An individual company can look safe until it is not. A restaurant chain can lose its edge, a retailer can misread the consumer, a bank can take the wrong risks, a telecom company can carry too much debt, a once great brand can hire the wrong leadership. And when that happens, the dividend can be cut. If the business deteriorates badly enough, the stock price can fall at the same time the income disappears. That is the double danger of bad dividend investing. People often chase the yield. They see 8%, 10%, 12%, and they think they found income. But sometimes a high yield is not an opportunity. Sometimes it is a warning light. The market may be telling you that the dividend is not sustainable or that the underlying asset is declining. That is why dividend ETFs can be useful for many people. Instead of trying to pick one company and hope it keeps paying forever, an ETF owns a basket of dividend-paying companies. If one company weakens, the fund can remove it or reduce exposure according to the fund's rules. You get diversification, you get simplicity, you get a system that does not eliminate risk, but it changes the risk. One type of dividend ETF focuses on companies with long records of paying and increasing dividends. These are often called dividend aristocrats. The logic is that a company that has raised its dividend for 25 years or more has demonstrated a certain kind of durability. It has survived recessions. It has survived rate cycles. It has survived inflationary periods, political changes, wars, panics, and mistakes. That record does not guarantee the future. Nothing does. But it tells you something about the quality of the underlying business and management discipline. Another type of dividend ETF is broader. It may focus on high-quality companies that pay meaningful dividends across different sectors of the United States market. This can give an investor a higher yield than some aristocrat-focused strategies, but it may also bring different risks depending on the companies inside the fund. The basic principle remains the same. You are not just buying a dividend, you are buying the businesses that support that dividend. There is a big difference. If the businesses are strong, the income can be resilient and may grow over time. If the businesses are weak, the income is fragile, even if the yield looks beautiful today. There is also an international version of this idea. Some companies outside the United States pay significant dividends. Some operate in markets with different demographics, different growth paths, and different valuations. International dividend ETFs can give you exposure to those companies and those countries. That can be valuable because the world does not grow in one straight line. There are periods when the United States leads. There are periods when other markets become more attractive. There are periods when currency movements add to returns and periods when they subtract from them. But international dividend income comes with extra variables, political risk, currency risk, different accounting standards, different tax treatment, different legal systems, different shareholder cultures. Again, there is no free lunch. A higher yield in another country may compensate you for risk you do not fully understand. That does not mean you should avoid it. It means you should respect it. Then there are real estate investment trusts, or REITs. A REIT is a structure that allows investors to own exposure to real estate without buying a property directly. Some REITs own physical real estate, apartments, warehouses, office buildings, hotels, data centers, medical facilities, shopping centers. Other REITs are mortgage REITs, which invest in the debt tied to real estate rather than the properties themselves. The difference matters. An equity REIT that owns property is tied to rental income, occupancy, property values, operating costs, and debt financing. A mortgage REIT is tied more directly to lending spreads, interest rates, leverage, and the performance of the underlying mortgages. That is why a mortgage REIT can show a very high dividend yield and still be much more volatile than people expect. The yield looks attractive, the mechanism underneath may be fragile. This is where many investors get hurt. They look at the payout and ignore the engine. The engine is everything. If you are investing for income, you should never make the dividend yield the only factor. It is tempting because income investors want income. But a high dividend from a weak asset is not income. It is often just your own capital being slowly returned to you while the value of the asset declines. A good income asset should ideally do two things. It should pay you today, and it should have a reasonable chance of preserving or growing its income power over time. That is why the quality of the asset matters more than the size of the current yield. The next level is owning real property directly. This is where the income story becomes more powerful, but also more demanding. Owning rental real estate is different from owning shares in a fund. When you buy a property, you are buying something tangible: land, walls, a roof, plumbing, a neighborhood, a tenant relationship, a local market, a tax structure, a maintenance obligation, a set of risks you can see and many you cannot see until they happen. The appeal is obvious. If you buy the property correctly, rent comes in every month. That rent pays the property taxes, insurance, repairs, property management, vacancy costs, and financing costs if you use debt. If there is money left over after all expenses, that is cash flow. That cash flow can help replace a paycheck. But the important phrase is, if you buy it correctly. Real estate can make people wealthy, but it can also fool them because it is so easy to confuse gross rent with profit. A property that rents for $2,000 a month does not make you $2,000 a month. That is only the top line from that. You must subtract property taxes, you must subtract insurance, you must subtract repairs, you must subtract ongoing maintenance. You must subtract management, even if you think you will manage it yourself, because your time is not free. You must subtract vacancy because tenants move out. You must subtract capital expenditures because roofs get old, furnaces break, and houses age whether you want them to or not. Only after those expenses do you know what the property actually produces. That is net operating income before financing, and if you are using a mortgage, you still have debt service after that. The numbers matter more than the story. Imagine you buy a property for $200,000. It rents for $2,000 a month or $24,000 a year. After taxes, insurance, repairs, vacancy, and management, maybe you have $10,000 left. If you paid all cash, that $10,000 on a $200,000 purchase is a 5% cash return before considering tax effects and appreciation. Is that good? It depends. It depends on your alternatives. It depends on the local market. It depends on your risk tolerance. It depends on whether rents can rise. It depends on whether the property is in a stable area. It depends on whether repairs are likely to surprise you. It depends on whether 5% is enough compensation for the effort and concentration risk. For some investors, 5% is not enough. They may require 7% or more in cash, on cash return to justify the work and risk. That is not a universal rule. It is a way of thinking. Every investor needs a hurdle rate. Without a hurdle rate, you are just buying something because it feels like an investment. Real estate also has a feature that many wealthy people value: tax treatment. Depreciation allows you to recognize that a building wears out over time, even if the property may be rising in market value. That depreciation can offset rental income on paper. There may also be deductions for ordinary and necessary expenses connected to operating the property. This can make real estate income tax efficient compared with ordinary wage income, depending on your situation and the law. But this is exactly where people should be careful. Tax rules are technical. They change. They depend on facts. You need a qualified professional, not a casual assumption. The broader principle is that real estate can create income, provide tangible ownership, and offer tax advantages. But it is not passive in the pure sense. Even if you hire a manager, you are still responsible for capital decisions. You still own the risk. You still must understand the market. Real estate rewards people who know their numbers and respect the operational reality. It punishes people who say, "How hard could it possibly be?" That question has humbled more investors and business owners than almost any other sentence. In markets where property prices are high, good deals are harder to find. That does not mean they do not exist. It means you must look harder, analyze more carefully, and be more patient. The easy deal everyone sees is usually not the great deal. The great deal is often found by the person willing to do the work others avoid. That is true in real estate. It is true in business. It is true in investing. Generally, the next income asset is a business. This is where the potential returns can become much larger, but the difficulty also increases sharply. A business is an income machine if it works. It sells something, collects revenue, pays expenses, and whatever is left belongs to the owners. That distinction between employee and owner is one of the most important distinctions in capitalism. An employee is paid for work. The owner receives the residual profit after everyone else is paid. If a business produces $1 million in revenue and has $600,000 in expenses, the remaining $400,000 is profit before taxes and other adjustments. That profit belongs to the owners, not necessarily to the workers. Sometimes the owner also works in the business and receives a salary. But the salary and the ownership profit are different streams. One is compensation for labor. The other is return on ownership. This distinction is powerful because ownership can scale in a way labor cannot. But that does not mean owning a business is easy. In fact, it is one of the hardest ways to create income. There are two broad paths. You can start a business or you can buy one. Starting a business requires creation. You must find customers, build a product or service, hire people, manage costs, sell, adapt, survive mistakes, and endure periods where nothing works as planned. For the right person, this can be fulfilling. For the wrong person, it can be painful and expensive. Buying a business sounds easier because the machine already exists. There may already be customers, revenue, employees, systems, and profit. But buying a business introduces another set of risks. Why is the seller selling? Are the profits real? Are customers loyal to the business or to the owner? Will employees stay? Are margins sustainable? Is there hidden debt? Is the industry declining? Does the buyer understand operations? Many people on the internet make business buying sound simple. Buy a laundromat, buy a car wash, buy a small service company, hire a manager, collect checks that can work in some cases, but the principle is simple. If a business is small enough to be affordable for a first-time buyer, it is often small enough that the owner's involvement matters. If you buy a small business and assume it will run itself, you may discover that what you really bought was a job with leverage. That is not necessarily bad. It may be exactly the right path. But you must understand it to be a passive owner. You usually need more capital, a larger business, stronger management, better systems, and a margin of safety. Smaller businesses can create excellent returns, but they usually require work, judgment, and active involvement. That is why business ownership belongs higher on the difficulty ladder. It can produce income, it can produce wealth, it can give you control, but it can also fail. And when it fails, it often fails in ways that feel personal, because your time, identity, relationships, and money may all be tied into it. So the principle is this: business ownership is not just an asset, it is a system of people, customers, products, operations, capital, culture, and competition. If you do not understand the system, you do not own an income stream, you own a problem. If you do understand it, you may own one of the most powerful income-producing assets available. The last category is private credit, often described as peer-to-peer lending. This is another way to turn capital into income, instead of lending money to the government through treasury securities or owning companies through dividend ETFs. You lend money to individuals or businesses that need capital. They may need money to buy a car. They may need a personal loan. They may need funds for a real estate project. They may be flipping a property and need short-term financing. You provide the money, and in exchange they agree to pay you interest. The appeal is the yield. Private credit can pay much higher interest rates than government debt, sometimes 5%, sometimes 10%, sometimes 15% or more. But higher interest rates exist for a reason. If a borrower is paying you 10 or 15%, you must ask why. Why can they afford to pay that? Why are they not borrowing at a lower rate from a bank? What risk are you taking that the bank chose not to take? What happens if the borrower defaults? This is where collateral becomes important. If you lend money without collateral, you are relying mainly on the borrower's promise and ability to pay. If something goes wrong, recovery may be difficult. If the loan is backed by real estate or another asset, there may be a way to recover some value in a default. But collateral is not a magic shield. You need to know the value of the collateral, the legal process, the seniority of your claim, the loan-to-value ratio, and how long it would take to recover money if the borrower stops paying. Private credit can create income. It can be a real asset class. Institutions have moved enormous capital into private credit because banks have pulled back from some forms of lending and investors want yield. But the risks are not always visible. The loans may be illiquid, you may not be able to sell quickly, defaults may rise in recessions, platforms may have their own risks. Underwriting quality matters enormously. This is not something to enter casually because the yield looks attractive. Again, the principle is not yield first. The principle is risk, adjusted income. How much income am I earning for the risk I am actually taking? What happens if the borrower does not pay? What happens if the economy weakens? What happens if property prices fall? What happens if I need liquidity? If you cannot answer those questions, the investment is probably more complex than it appears. Now step back and look at the whole picture. Treasury securities can provide stable income with relatively low risk, but limited growth and interest rate sensitivity. Dividend ETFs can provide income from businesses, diversification, and potential growth, but they carry market risk and business cycle risk. Real estate can provide rent, tax advantages, and tangible ownership, but it requires capital management, analysis, and tolerance. For operational surprises, business ownership can create powerful income and wealth, but it requires skill, systems, work, and the ability to deal with uncertainty. Private credit can produce attractive yield, but it exposes you to borrower risk, collateral risk, liquidity risk, and underwriting risk. None of these is perfect. That is the point. The goal is not to find one asset that solves every problem. The goal is to build a system where different assets do different jobs. Some assets provide stability, some provide growth, some provide income, some provide inflation protection, some require work but offer higher return. Some require less work but pay less. If you are trying to replace a paycheck, you have to think in systems, not slogans. A paycheck feels simple because it arrives regularly. But behind that paycheck is a business system someone else owns. Customers pay the company. The company pays expenses, then it pays employees. When you want to replace your paycheck with assets, you are trying to build your own income system. You are moving from being paid by someone else's machine to being paid by machines you own or finance. That takes time. The math is unforgiving. If you want $80,000 a year in investment income and your assets yield 4%, you need $2 million of income. Producing capital, if your assets yield 8%, you need $1 million. But the 8% path usually carries more risk than the 4% path. That is why chasing yield can be dangerous. It looks like it lowers the amount of capital you need, but it may increase the probability that the income fails. A fragile 10% yield is not better than a durable 4% yield if the 10% yield collapses in the first recession. The central question is not, how fast can I quit my job? The central question is, how durable is the income that would replace it? Durability is everything. If you leave your job based on income that disappears when rates fall, tenants leave, dividends get cut, a business slows, or borrowers default, then you have not built freedom. You have built dependence on a fragile structure. Real freedom comes from a system with margins of safety. You need liquidity, you need diversification. You need realistic expectations. You need tax awareness. You need a reserve for surprises. You need to know which income streams are stable and which are cyclical. You need to avoid leverage that can force you to sell at the wrong time. And you need to understand yourself. Some people should not own rental properties directly because they hate operations. Some people should not own businesses because they do not want the stress. Some people should not chase private credit because they do not know how to evaluate borrowers. Some people should not rely entirely on dividend stocks because market volatility will cause them to panic. The best asset is not the one that looks best in a spreadsheet. The best asset is the one that fits your temperament, knowledge, capital, time horizon, and risk tolerance. That is why education matters. Institutions profit when individuals do not understand how money works. They profit when people keep all their capital idle. They profit when people chase products they do not understand. They profit when people confuse complexity with sophistication. They profit when people buy yield instruments without reading the mechanism underneath. The financial system is not designed to make every person free. It is designed to move capital toward those who understand the rules. Once you learn the rules, the world begins to look different. A bank account is no longer just a place where money sits. It is a low-yield instrument with safety, liquidity, and inflation trade-offs. A stock is no longer a ticker. It is a claim on future cash flows. A dividend is no longer free money. It is a distribution from a business. A rental property is no longer just a house. It is an operating asset with revenue, expenses, liabilities, and tax consequences. A business is no longer just a brand or a storefront. It is a system that either creates value in excess of cost or slowly dies. A loan is no longer just interest. It is a claim against a borrower whose ability and willingness to pay must be understood. That is the mental shift. You stop asking, "What should I buy?" You start asking, "What system am I building?" If I were building an income system, I would not begin by trying to be clever. I would begin by defining the required income, the capital available, the time frame, and the acceptable risk. Then I would build in layers. A defensive layer for stability, a business income layer for dividends and productive assets, a real asset layer where I have knowledge and can operate or hire properly, an entrepreneurial layer only if I am willing to do the work or buy into a system I understand, a credit layer only if I can evaluate the borrower, collateral, and downside. And above all, I would keep learning before I keep reaching. The person who wants income immediately often takes too much risk. The person who wants income intelligently builds the base first. There is nothing wrong with wanting to replace your paycheck. It is one of the most rational financial goals a person can have. But the path has to be built with honesty. You cannot replace active income with fantasy passive income. You replace it with assets, systems, discipline, and time. You buy assets that pay, you reinvest. You improve your skill. You avoid blowing yourself up. You keep expenses under control. You understand taxes. You understand cycles. You do not let excitement make decisions for you. You do not let fear keep you from building. The 5 asset categories are not just 5 ideas. They are 5 different machines. Treasuries pay because governments borrow. Dividend ETFs pay because companies earn profits. Real estate pays because tenants need places to live or operate. Businesses pay because customers buy something at a price above cost. Private credit pays because borrowers need capital and are willing to compensate lenders. Each machine has rules. Learn the rules before you depend on the income. That is how you move from working for money to making money work for you in a serious way. Not overnight, not without risk, not without sacrifice, but possible. And once you understand that, your financial life changes. You no longer see your paycheck as the only source of safety. You see it as one income stream among many possible income streams. You see every dollar you save as a worker that can be assigned a job. You see every investment decision as part of a larger system. That is how durable wealth is built. Not by chasing the highest yield, not by copying someone else's portfolio, not by believing that one asset can save you, but by understanding the machine, respecting the risk, and building a system strong enough to keep paying you when you are no longer willing or no longer able, to keep trading your time for money. That is the real goal, to own enough productive assets that your life is no longer controlled by the next paycheck. And if you want that, the process begins with one decision: stop thinking like someone who only earns. Start thinking like someone who owns.